No wealthy person, no rich person got rich because of the 401k or their IRA. And you got to pick, would you rather be broke or would you rather have $1 million? And people will say, but what if I can't get an 8% return on my money? What if I can't get a 10% return on my money? What if I only have $500,000? Okay, you got $500,000. What do you have now? Nothing. What's better, $500,000 or nothing?
What is the biggest mistake people make when they get paid?
Oh man, the majority of people are not investing their money. I was reading a couple of articles just recently, and one article said, I think it was 55% of Americans have no investments at all. Another article said it was 47%. But when we talk about 47 to 55% of Americans with zero investments at all, that means no real estate investments, no cryptocurrency investments, no stock market investments, no 401k, no IRA, no investments at all. So you have, if not the majority, half of Americans that are working and hoping to one day retire. And how are they going to do that? Well, they're hoping that the government is going to take care of them through Social Security. But as we've been talking about on our channel, that is, oh my God, not a good plan, as Social Security is drying up. Social Security is running out of money. Inflation is making everything so much more expensive. So now Social Security is having to increase the amount of money that they're paying out. So what does that mean? The money that you and I are paying for Social Security right now in our income, because anytime we get paid, you have to pay these FICA taxes. Part of those FICA taxes, a big chunk of those FICA taxes go straight to Social Security. So now when you're paying these Social Security taxes, this money was supposed to be used to pay for your retirement. But what's actually happening is you're paying these Social Security taxes to pay for somebody else to retire. So everybody who is under the age of 45 right now is paying these Social Security taxes, not for their own retirement, but for somebody else to retire. And then when it comes time for you to retire, what's going to happen? I don't know. And this is where everyone says, oh, it's not going to be an issue. The government will take care of you because they'll just be able to print bigger Social Security checks. And you're right. There's a good chance that if it comes down to that, the government will print bigger Social Security checks. But what does that mean? The government prints money, they give you a bigger Social Security check. You feel good because you got a bigger Social Security check, but it actually cannot stretch as far anymore because that creates inflation. So yeah, you got a bigger Social Security check, but it doesn't buy you as much because inflation happened and now you're poorer than you were before. So what are you going to do if half of Americans are getting paid and not investing anything? And I'm talking about not even their 401ks. I'm not a huge fan of the 401k. I don't invest my money into an IRA or 401k, but that is a great start. And for the average person, it's a great way to start investing your money. But this is the number one mistake that so many people are making. They live in a net zero lifestyle. Net zero means I make $1,000, I spend $1,000.
Right.
And this is the way that we're bred to think. We're bred to think, okay, oh my God, if I can make $1,000, I can go out and buy this nice vacation. Oh my God, if I can make $10,000, what can I do with my money? I can go buy X, Y, Z. So this is the way that we're trained to think. We're trained to think in terms of spending. We're not trained to think in terms of investing. And the only way that somebody can build wealth is through investing their money. And by investing their money into assets that will pay them, that way they can rely on these assets when they hit a point where they don't want to work or they can't work. Because most people are working towards a retirement, quote unquote retirement, which means that, hey, I work from now until the age of 65. When I'm 65, I'm going to quit. And then when I quit, what am I going to do? Well, we'll worry about that a little bit later, but you're going to no longer have an income stream. And when you don't have an income, how are you going to afford your lifestyle?
Right.
So this is the issue that so many people are going to face. We're already facing a retirement crisis. I mean, we're seeing this happen with the baby boomer generation. What is going to happen with millennials? What's going to happen with Gen Zers if people are not starting to put money away? And it's not just for retirement. It's for financial freedom so you can live your life the way you want and have investments to fall back on.
Yeah, I think a lot of people, when they think about investing, they just get kind of scared about they need $1 million, they need $1 million plus. Is there a certain number that somebody needs to retire with?
Well, retirement is a different question, I think, because how much money do you need to retire is going to depend on who you are. USA Today says you need $1.6 or $1.8 million in order to retire if you're a millennial. that number is always going to change. It's going to depend on you. I mean, it's going to be in the millions if you want to be able to live financially free. But the bigger question is, how much money do you need to start investing? Because so many people say, oh, I will start investing when I get a raise. I will start investing when I get this bonus. I will start investing when I get a bigger paycheck, when I get a better job. And that is the mindset that we need to change, because if you tell somebody, hey, you need $5 million to be financially free, what are they going to do? Oh, it's not possible for me. I'm never going to do it. There's no point for me to try.
Right.
But what you should be doing is saying, okay, I make, let's just say, $1,000. Mm-hmm. How much of this money is going to be invested? How much of this money is going to be saved? And how much money is this going to be spent? And so this is where, I have the 75-15-10 plan, which says now for every dollar that you earn, whether it's $1 or $1 million, you got to put this dollar through the 75-15-10 plan, which says that 75 cents is the maximum that you can spend. 15 cents is the minimum you should be investing, and 10 cents is the minimum you should be saving. I'm going to talk about the saving part in just a second, because you're never going to become wealthy by just saving your money. Because right now, when you save your money is not growing. It's just sitting there flat. Your savings are dead because your bank isn't paying you anything. And so when you save your money, your goal is not to save to build wealth. Your goal is to save to protect yourself against a financial emergency. So when you save your money, you should have a goal of saving somewhere between 3 to 12 months worth of your expenses, depending on your risk tolerance. If you have a high risk tolerance, you only need to save around 3 months. If you don't have a high risk tolerance, save closer to 12 months. You're going to figure out where in the range you want to be. After you save that money, you don't want to save another penny. That's it. Your emergencies are saved for. That's when now you want to be taking that money and reallocating it towards your investments. So now you're investing a quarter of every dollar that you earn, and you're spending a maximum of 75%, a maximum of 75 cents out of every dollar that you earn. So now you can kind of configure this depending on you. If you can live off of half of what you make and you can invest half, great. And as you start to invest more, you're going to have more income. As you have more income, it's going to go back through the funnel. Because now when your investments make you $1,000, you take that $1,000 and you put it back through the funnel. But the whole idea here is you need to pay yourself first. Mm-hmm. You have to pay yourself first. This is what every wealthy person, this is what every rich person does. But the majority of people will not do it. And they will say the reason why wealthy people can do it is because they're rich, they're wealthy, it's easy for them. But the reality is, if you want to go from where you are now to wealthy, you have to make that sacrifice. Mm-hmm. You have to start living below your means and then do what with your money? You need to invest it. And this is where now we got to understand, what does it mean to invest? It does not mean that you have to take every penny as soon as you earn it and invest it. It means that money needs to be invested at some point. So that money, you can have it sitting there waiting to be invested if you're waiting for the right investment opportunity, if you're waiting for the right place to invest it. But that money has to be there with the purpose to invest, not with the purpose to be spent.
So if I'm somebody that has, that makes, like you said, $1,000, whatever, on my paycheck, but what if I have a lot of things going on and I can't put away that 75? Is it still worth it to invest?
You have to pay yourself first. Every single wealthy person does that. You have to put yourself first. Because what people are doing is they're putting Amazon in front of them. They're putting Apple in front of them. They're putting Lululemon in front of them. They're putting every other corporation in front of them. And so who are they paying? They get paid. What do I got to do? Oh, I got to go to the mall. I got to go to the Gucci store. I got to pay Gucci before I pay myself. I got to go to the Apple store, get the new AirPods before I pay myself. I got to go to the BMW dealership and pay for my new car before I pay for myself. So what are you doing? You are financing every single one of these companies. If you're wearing name brand clothes, if you have a name brand phone, if you're using an Apple iPhone, if you have a name brand laptop, if you have a name brand anything, you're paying for these corporations to get rich before you pay for yourself to get rich.
So I want to unpack that a little bit, but if somebody, to think like the majority for a second, if I want to kind of step into their shoes, if I'm somebody that can only afford, let's say I can only afford to invest, a small amount, less than 75% of my income, my paychecks. If I can only afford to invest so much, and then I look at the numbers, say 30, 40 years down the line, and I still can't retire with that, and I still can't build wealth with that. So why would I invest and build wealth when at the end I still can't, nothing's going to come of it? Why would I do it?
$100 a month adds up. $100 a month compounded month after month, year after year adds up. If you invest $100 a month, and we're talking just $100, if you invest $100 a month from the day that you start working until the day that you retire, and you can get a 10% annual return on your money, and you do this every single month, and you don't miss a month, you will be able to retire a millionaire with just $100 a month. You have to keep doing it. You have to let your money compound. You have to let your money grow. This is why I've talked about on our channel janitors who have retired with millions of dollars. We have talked about people who are parking lot attendants who retired with millions of dollars. How? Slow, steady investments, stable investments that you keep investing in every month, and you let the money compound.
And $1 million today is great. But in 45 years from now, is $1 million really going to matter? If I can spend that $100 a month today, I'd rather do that if I can invest. If I'm not going to build wealth within the next 45 years because I don't have enough to do that and I can't retire, what I'm asking is why not just spend that money?
Well, yeah, you're right.
Yeah.
And that's the question you got to ask yourself. Yeah, maybe $1 million isn't everything, but guess what? $1 million is better than nothing. And you got to pick, would you rather be broke or would you rather have $1 million? And people will say, but what if I can't get an 8% return on my money? What if I can't get a 10% return on my money? What if I only have $500,000? Okay, you got $500,000. What do you have now? Nothing. What's better, $500,000 or nothing? You got to make that decision for yourself. And this is where, again, you have to pay yourself first. And this is where people will say, how am I supposed to put aside an extra 25 cents out of every dollar that I earn? I'm already struggling living paycheck to paycheck. Look at it like a tax. If the government raised your taxes by another quarter, another 25%, guess what you're going to do? You're going to pay the tax, and you're going to find a way to live off of the less income. You got to do the exact same thing. Think of it like a tax. You are taxing yourself, but now to actually make yourself wealthy, take the extra money, put it aside so you don't see it. Have a separate bank account, a separate account for your investment cash, a separate account for your savings cash, a separate account for your spending cash. Have the separate accounts. That way now you have money willing and ready to invest. And if you tell yourself, hey, I don't want to invest, I don't care about the way that I'm going to live my life in 45 years or in 10 years or in the future, I just want to enjoy my life now, fine. But this is not the right channel for you. This is not the right content for you. If you want to become wealthy, this is what you have to do. If you don't want to become wealthy, that's your choice. But if you want to become wealthy, that's what you got to do.
So when you mentioned before about, the road to investing and building wealth and how you got to pay yourself first, right? But if you take some of that money and you actually buy other things with it, Gucci, iPhones, I mean, don't you think that people deserve to kind of have nice things too while they invest? You know what I mean? You know what I mean, though?
Do they deserve it? Why do you deserve it?
Well, because they make money. They're getting paid.
It's a good question. The topic of deserve. What do you deserve? People will say, oh, I work so hard. I deserve the new iPhone. I work so hard. I deserve to reward myself with a new car. And what are you doing? You are sacrificing your future health for what you want to deserve today. You are sacrificing your future financial health for today's deserving things that you want. And that's the culture that we live in. People don't want to wait. They don't want to earn what they have. They just want it now. That's why we have this consumer debt crisis, because, I want this $2,000 vacation. I worked hard. I can't afford it. So what do? Let me put it on my credit card. And this is where, it's just so ironic. People will always, anytime I talk about investing, they'll always say, how am I supposed to get an 8% return on my money consistently? Markets go up, markets go down. How do I do that? Well, do you want to know somebody who's getting a consistent 15 to 20% return on their money every single year? It's your credit card company. Every year, you're paying them 18, 19, 20% a year in interest every single year. And you're doing this and you're making your credit card company rich. Why? Because you're spending money that you don't have, because you want to have all these nice things that you feel like you deserve right now. There's a difference between deserving something and earning something. What I want you to do is earn something. And that might seem harsh because you worked hard. I get it, you worked hard. But you got to understand what something really costs and what is costing you in the future. Because that $2,000 vacation is not just $2,000. It's the $2,000 that could have been invested. It's the $2,000 that you could have put into an investment and got 7, 8, 9% a year on. It's $2,000 that now you have to pay interest on because you couldn't afford it in the first place. I want you to have the nice things. I want you to have the nice vacations. I want you to have the nice car. I want you to have all the nice things that you want. But you got to be able to afford it first. And affording means you have to be able to afford it cash. When we're talking about consumer expenses, liabilities, things that don't make you any money, you need to make sure you can afford them without going into debt. And you're going to say, oh, but that's hard. How am I going to be able to afford this? Because then I have to work harder. I have to save more money. Yes, you're right. It is harder. But you got to make that decision for yourself. Do you want to live broke the rest of your life? Or do you want to live wealthy the rest of your life? If you want to live wealthy, you got to make that sacrifice today. That way you have more money to put aside towards your investments. And this is where you have to get financially educated. Now, going back to where do you start investing? Because the easiest, simplest, most accessible place for so many people is your 401k or your IRA. These are easy people to just start investing if you have no investing experience, no investing knowledge. Now, I don't have a 401k. I don't have an IRA. I invest my money myself. But if you are the average person and you just want to get started, it's better to have a 401k or an IRA than to blow your money at Gucci, okay? And these are the most accessible investment options that you have, but you just need to understand how they work. You need to understand how they work. That way then you can graduate from just your 401k or your IRA into your own investments, because the mistake, so we talked about it in the beginning of this video. Half of Americans have no investments at all. Half of Americans have an investment. Out of those 50% of Americans or so that have an investment, the majority of those now only invest in their 401k. So the people that are actually self-investing, that are investing things outside of their 401k and IRA, is really just a small subset of the American population. Half of people have no investments at all. Half of people have an investment. Out of those half of people that have an investment, most of them are only invested in their 401k or IRA. And then some of them are now investing on their own in the stock market, in the real estate market, in the cryptocurrency market. And so this is where, okay, if you're not investing at all, start. And then you can graduate into the other places. So your 401k or IRA, your 403b or 457b, all of these are tax-deferred retirement accounts. The whole idea behind that is when the government realized that they couldn't afford to pay for your retirement through Social Security alone, when pensions started going bust, that's when the government partnered with corporations and Wall Street to come up with something called the 401k. This came through the ERISA Act. The whole idea here is now you can invest into this tax-deferred retirement account so you can start funding your own retirement. So you take a little bit of your paycheck, you put it into, let's just say, a 401k. Your 401k now is going to invest this money because you're going to work with some sort of investment person, a brokerage, whoever it is. You're going to have this money invested in the stock market, whether it's through a mutual fund or through a passive index fund. This money is going to be invested, and the goal is this money will be invested for the rest of your career. When it comes time for you to retire at the age of 65, you will be able to pull your money out and either tax-free or pay your taxes then, depending on what type of 401k that you used. It could be a Roth 401k or a traditional 401k. A traditional 401k means I don't pay any taxes on my money today. I invest my money grows tax-free. I don't pay any taxes on my money when I get profits. I just keep reinvesting it. Then when I turn 65, I can start pulling my money out, and then I'll pay taxes then. A Roth 401k says I'm going to pay taxes on my money today, so I have less money entering my account because I pay taxes on it, and then this money will grow. Anytime I make a profit, I don't have to pay any taxes on it. And then when I hit the age of whatever I want, retirement age, after 59 and a half, then I will be able to pull my money out. And with the Roth 401k, you can pull your money out tax-free.
So why is that bad, though? Why is it bad that people are investing in a 401k and that's it? If I'm putting a certain amount of my paycheck away, that sounds like a pretty good deal, right?
You were never supposed to rely on your 401k to retire. The founder of the 401k has come out and said that the 401k has gone awry because so many people are relying on their 401k to fund their retirement. No wealthy person, and I mean an actual wealthy person, not somebody who has $1 million, a real wealthy person, no wealthy person, no rich person got rich because of the 401k or their IRA. Now, for the average person, they can be okay as your, starter tool, but again, that is not supposed to be your sole retirement plan. You need to be investing your money outside of that because you will, one, have more control of your money. You need to invest more money. You'll be able to invest your money with less fees because guess what? When you invest your money in a 401k, you're paying fees. And I know some people watching this video are going to say, wait, my 401k is costing me money? Yes, it is. NerdWallet put out a study and they said that 90% or 90-some% of people, Americans with a 401k, have no idea of what their 401k fees are. And these fees are going to eat up your investment profits. Meaning, hey, if you get financially educated, like what we talk about, you can invest your money yourself, get better returns, pay less fees, and have full control of your money. So that's my issue with it. Again, if you're just starting off and you have no other financial options, if this is the only thing that you know of, it's better to have a 401k than to just blow your money. But you got to think bigger than that. And so now going back to the question of taxes, because it's a funny argument between should I put my money into the Roth 401k or traditional 401k? Because with the traditional 401k, you pay your taxes when you're pulling money out. This is very attractive to a lot of people because now you get to put more money into your account today. You put more money in, so your money gets to grow with more money. And then when you pull your money out, that's when you pay taxes. The whole idea being when I'm 65, I'm not going to have a job. I'm not going to have an income, so my tax rate is lower. A couple things I want to mention regarding that. First, where are tax rates going? Are they going up or are they going down? Now, nobody can predict that. I can only guess. But based off of where our national debt is going, which is going up, and if I also take a look at where government spending is going, which is up, the government has to pay for this somehow. The government gets their money through taxes. So I think that there is a good chance that our tax rates can go up. Now I can be wrong, but there's a good chance that our tax rates are going to go up. Now to the second point. But when I'm old, I'm going to have no job. No job means no income. No income means lower tax rates. So if American tax rates go up, but my tax rate goes down, what's the big deal? Well, if your goal is to have no income when you're 65, then this is not the right education channel for you. Our goal is to build income streams each and every year. That way, by the time you get old, you're not going to have no income. You're going to have a whole bunch of income. Right. You want to keep stacking your income. That way, more income is coming in every single year. So, just again, it goes back to your goals. Your Roth 401k means that you pay taxes today at whatever tax rates are today. Then your money can grow tax-free. Then when you pull the money out, you don't got to pay any taxes. Now, again, if your goal is to stack your income, then that might be more beneficial for you because now when you're 65, if you're making a lot of money and you have a high tax rate, well, you already paid taxes. So that's kind of the question that you have to ask yourself. And now my goal is not to say, here's how to invest your money in a 401k. My goal is to say, okay, if you want to do that, fine. But you have to understand that you cannot rely on that. And you have to understand that you can do much better outside of your 401k if you know how to invest your money yourself. Now, investing your money yourself is not for everybody, but if you want to be part of that minority mindset where now you are in charge of your own money, you have to get financially educated on how to invest your money yourself. And then people say, but I can't get the same tax breaks that I can outside of my 401k that I can inside of my 401k. Yes, you can. Why is it that every wealthy person in the United States can get such big tax breaks? It's because they understand how to invest their money. And it's not illegal tax breaks. These are legal tax breaks that a tax code has to offer. For example, real estate is one of the biggest legal tax shields that the IRS offers. That means that, hey, you can make money every single month from real estate and pay very little taxes, if any, if you know how to structure your deal the right way. Because real estate offers something called depreciation, which means that every single year that your property gets older, you can depreciate a piece of your real estate value against your taxes. So let's assume that I made $10,000 in profit from my real estate this year. cash flow. I don't have to do anything to earn this money. $10,000 came into my bank account. Normally, you'd have to say, hey, IRS, I earned $10,000 worth of income. I got to pay taxes on $10,000. It doesn't work like that with real estate, because now I get to say, hey, IRS, I earned $10,000 worth of income, but my property is a year older, so I'm only going to pay you taxes on $5,000 worth of income, because I get to depreciate the value of the property, even if the value of my property went up. If the property value doubled, I still get to take that tax break against my income. So I'm winning on both sides. My value of my property is going up. I get tax breaks. And so now I made $10,000. I only pay taxes on $5,000, but I get to keep $10,000 in my bank account. And then let's assume that I buy this property for $1 million. It goes up in value to $2 million. I sell it. Well, now I have $1 million worth of profit. I got to pay taxes on. If I pay taxes on it, now I'm also going to pay less taxes than if I earned that money from a job. If I was a doctor and earned $1 million, I'd be paying way more money in taxes than if I sold my investment property for a profit of $1 million. But I don't have to pay any taxes legally right now, because what I can do is I can take all of that money, all $2 million, and use it to buy a bigger real estate property, and I can pay $0 in taxes today. And I can do that again and again and again and again and again until I die and never have to pay any taxes on these depreciation. So that is one of the biggest loopholes now that the wealthy people use. And honestly, it doesn't even feel right calling it a loophole, because it is a very commonly used tax break. It's called 1031, that was created to incentivize real estate investors to keep reinvesting their money. Now, you can either hate it or you can use it. And that's the decision you have to make. You know, you can only take advantage of it if you start to, one, get financially educated and do something about it. You don't need $1 million in cash to go out and start investing. You can start with a small property, $100,000. And you don't need all of your own money to go and buy it. You can use the bank's money. So now you want to buy a $100,000 property or a $150,000 property. You need $20,000, $30,000 of cash. You can use it as a down payment to go buy this property. You start getting cash flow from this property. Once that property value starts to go up, you can now flip it, and not in the traditional sense of flipping, of just taking that cash. You can flip it into a bigger property, pay no taxes on that appreciation, get bigger cash flows, bigger tax breaks, and just keep doing that again and again and again. So this is what financial education is all about. Sure, again, you know, your 401k IRA is the great start, but if you really want to build wealth, real wealth, you have to know how to invest your money outside of your 401k and just your IRA. And maybe real estate investing is now for you. You know, there's 7 billion people in the world, 8 billion people in the world. You don't got to do everything the same as everyone else. Maybe you really like the stock market. Hey, you can use the stock market strategically to build wealth. And there are, again, ways that you can do that to help mitigate your taxes. If you don't want to pay taxes, if you're really just focused on the tax side, hey, don't invest in dividend-paying companies. Invest in companies that are high growth, because now what they're doing is they're not paying you cash. Your goal is to see the stock price grow quickly, because now this company is reinvesting every penny that they have back into itself. Then when you sell, obviously you have to pay taxes, but you're already getting a tax break because your tax rates on investment profits are lower than tax rates from your job income. If you go work a job and you make $1 million, half of that is going in taxes. If you make $1 million from your investment profits, you're paying right now 20%. So there are so many different ways for you to now, you know, if taxes are your sole goal, there are so many other ways for you to get legal tax breaks, but you just have to know how to invest your money yourself.
Yeah, and I think you said it yourself. A lot of people want right now, and they want what's easy. And for a lot of people, real estate investing is scary, and going out and investing in stocks can be scary because they don't understand it. So when they look at these different investments and then they see that 401k, well, the 401k looks easy. They just sign up for it and put their money aside, and that's pretty much it.
Well, the 401k is investing in stocks. It's just removing that emotional barrier because you don't see it. When you invest in stocks through your own brokerage, now you're the one that's actually making trades or making your investments. As opposed to your 401k, you kind of have that little separation, that little barrier. So you assume that it's safer, but you're still investing your money in the stock market. I mean, you can diversify your money in your 401k as much as you want. You can have a safe fund, you can have an aggressive fund, you can have a blue chip fund. the end of the day, if the stock market crashes, your 401k is going to go down.
So what's the difference then? If I'm investing in my 401k or I'm investing in stocks on my own, what's the difference?
Well, with the 401k, you don't have the full control as you do if you invest in stocks on your own. If you invest in a 401k that your company offers you, chances are you're going to be limited as to which funds that you can invest in. And many times these funds are going to be high fees. Not every single time, but you're going to be limited as to which funds that you can invest in. When you invest in stocks on your own, now you have the freedom to invest in whatever ETF you want. You can invest in whatever index fund you want. You can invest in whatever stock you want. You don't have the option of that with the 401k. You're investing in funds that are controlled by somebody else. Many times they're actively managed, which means that now your fees are significantly higher. An actively managed mutual fund is going to charge you somewhere between 1 to 2% a year in fees. That will eat away your profits. 1% in fees might not sound like a lot, but it adds up every single year. It's why most people are going to pay 6 figures in fees on their 401k when you can get similar returns, if not better returns, with a passively managed fund with a lower fee. Now, again, there are places where actively managed funds are better than passively managed funds. There's a place and time for that. But you have to be educated and know what your fees are, know what you're paying for. You can get good returns investing your money yourself. That doesn't mean don't invest in a 401k. Try it out. Don't blindly listen to anything someone says. Don't blindly listen to what I got to say. Try it out. First, invest in your 401k, see what it's like. Then start investing your money yourself. See what it's like. See what you like better. Invest your money into ETFs. See what you like. If you're investing into ETFs and you're like, man, I don't like the companies that my ETF is invested in. I don't like the weighting of my ETF. I don't like how Tesla is such a big portion of my ETF. Okay, well, that means you want to be more involved with your investments. Maybe you should be investing in individual companies. But again, this goes down to you understanding you. If you're the type of person that says, I have no idea what I'm doing, I don't want to be involved, I don't want to see my investments, then hey, the 401k might be better for you. And then just investing your money into some ETFs might be better for you. If you want to be involved with your investments, like you're an entrepreneur and you want to help grow your investments, then real estate might be better for you. You might be investing in startups. You might be investing in smaller businesses. This is where you have to know you, right? I could talk about me all day long, but you are not me. And I'm not you. And you got to figure out what you is. So what I talk about doing is just educating. I'll give you my opinions, but I'm going to educate you in that financial education area, that way you understand what your options are. That way you can make the best decisions for yourself. Because for some person, real estate is going to be what makes them wealthy. For somebody else, stocks are what make them wealthy. For somebody else, it's going to be cryptocurrency. For somebody else, it's going to be investing in startups. You got to figure out where it is for you. I love real estate. I love investing in real estate. I love the cash flow that I get with real estate. I understand the tax breaks that I can get with real estate. And pretty much anybody who invests in stocks and real estate will tell you that real estate gives you kind of that predictableness. You get the cash flow, which is why everybody loves real estate for that, because now you can build income streams month after month after month, and you just keep stacking them. And that's why people like real estate. Stocks, you have more quicker upside potential. Because if you invest in a company that starts rallying, hey, you can see huge growth in your company quickly, but now what do? You can see it go back down. So, for a lot of real estate type investors, yeah, if they're investing in stocks, they might use that as another funnel for real estate. When they see huge gains in the stock market after a number of years, they sell it, and then they move their cash to real estate for the predictable cash flow. You got to figure out what's right for you.
I want to talk briefly. We mentioned 401ks, investing is what people need to do now if they want to build wealth. But you also mentioned about the boomer generation, Gen X. Before, people didn't need to invest like this. They had those pensions. So I kind of want to talk a little bit about pensions and what changed.
Well, the way a pension worked is a company would say, you work for us for 40 years. When it comes time for you to retire, we will pay for your retirement. And the way that they would do that is they had these actuaries, people working at companies, plugging in numbers saying, okay, we think you're going to live until you're 74 years old, and then we have to pay you X amount of dollars every single month. So they're plugging these numbers in, and then a couple things happened. First, the people started living longer. And so instead of living till 74, people started living until 77, 78, 79. And then these things started to increase the amount of money that these companies paid out, because they were paying out until a question mark. They didn't know how long you were going to live for. And so they would just keep paying and paying and paying. And then the cost of living also went up. So it was hard for them to predict how much money that you would actually need. And if people weren't able to live off of enough money, then that would create its own issues. So that's what created this whole pension crisis. We're still seeing it happen right now because some people are still relying on their pensions, and you're seeing pensions go bust around the country. But this pension crisis was just created by the idea of the government or your boss, depending who your employer was, because you had a lot of government pensions, which are also going under. But you had your employer promising you to pay for your retirement. And so you felt like you had no need to really do any of this investing because that was reserved for the institutions. Investing was reserved for the wealthy. And so they would take care of all that for you and promise you a return. And then when it came time for you to retire, they were supposed to pay you. Well, now that corporations are realizing the real cost of these pensions, they're not able to maintain them, so they started letting them go. So that was the whole reason why pensions started to go away. That's when Social Security really became popular as a way to take care of people, because if it's not the corporation, it'll be the government. But then the government ran into the same issues. People live longer, cost of living goes up. The government can't invest their money and get the best returns. They have all their other administrative fees. And so here we are now with the 401k as a compromise, where now it is the individual in charge. You can choose how much money you want to invest. You can choose how you want to retire. If you invest more, the goal is you'll be able to have more money when it comes time for you to retire. But again, you never want to just rely on your 401k or your IRA to be able to retire. You need to have your own investments. And I'm not saying don't have a 401k. I'm not saying don't have an IRA. I'm saying try it and figure out what's right for you, because as you kind of go on the financial education journey, you're going to see where's the right path for you. Some of you are going to start it and you're going to say, screw that. I don't want a 401k. Why am I locking up my money? I can invest in real estate and build cash flow every single year. And in 10 years, I'm going to have enough cash flow to be able to live off of. So why do I want to wait 40 years to start accessing my money? I want to invest it today. That way I have my cash flow. That way I can live off of it in 10 years. And now I'm financially free. Or you're going to come up with your other investment options. You're going to figure out whatever it is that you want to do. But this is where you got to know yourself, which comes down to also financial education. That way you can make the right decisions for you.
So I get paid, and we talked about before, kind of having ways to split your money. We talked about investing and saving. So now I'm investing. What do I do next? Is that it? Am I building wealth?
If you're investing your money, that's the whole plan. Your goal is to now invest your money into the assets that are going to either grow in value or pay you with cash flow. That way you have money to invest. Your savings, you should be saving only for 3 reasons. You're saving for an emergency. We talked about 3 to 12 months worth of saving expenses. Mm-hmm. You should be saving for purchases because you have to transact. So you want to make sure you have money to buy things, whether it's a big thing, maybe a car, maybe you want to buy a home, you need a down payment for that. Or you should be saving for investments. That's the 3 reasons why you should be saving your money. And then you have your spending money, where now when you spend money, you want to make sure that you're only spending money on things that you can afford. And you don't want to be financing your consumer expenses. So afford means if you want to buy something that's not a necessity, that you don't need to survive, that's not making you any money, you got to follow my rule of 5. If you can't buy 5 of them, you can't afford 1 of them. You want to go out and buy a $1,000 iPhone? Sure, no problem. You can't finance it if you want to be able to afford it. And you got to make sure you have $5,000 to afford a $1,000 phone. And this goes against modern thinking, because everyone's going to say, $5,000 to afford a $1,000 phone? Are you crazy? Yes, I am crazy. But if you want to be wealthy, you got to stop spending all your money. You're giving Apple all of your money. They don't need it. You need it more than they do. So don't go out and buy the new iPhone. Buy a used phone that's working. Keep the extra cash in your pocket and invest that money. So this is where that spending section is. You got to be smart with your money and not just blow your money.
Mm-hmm. But if everybody did that, though, we'd kind of have a problem, don't you think?
Why?
If everybody did that in the U.S., nobody spent money. Don't you think
I'm not saying don't spend money. I'm saying be smarter with your money. If all 350 million Americans suddenly became financially educated and stopped spending and living beyond their means, what would happen? Is that what you're saying?
That's what exactly.
Well, our economy would slow down in the short term, because now all of a sudden spending would slow down because people are not living off of debt. We live in a credit-based economy, which means people don't spend based off of how many dollars they have in their pocket. They spend based off of how much debt I can qualify for. And in the economic environment that we live in, nobody knows if you're spending credit or dollars. If I go to a restaurant and I only have $20 in my bank account, but I spend $100 because I put it on my credit card, the restaurant owner doesn't care and they don't know. They're getting you $100. Now you have to pay the consequences of that, because now when you go home, you get your credit card bill, you only got $20. Now you're in credit card debt. So now you have to pay back this $100 plus interest. So in the economic world, in the marketplace, nobody knows if you're spending dollars or debt. And this is how our economy runs. The reason we live in this credit-based society is because it allows the economy to grow much faster. Because now you're not spending $100, you're spending $100 plus credit. So you have a bigger spending capability, which allows you to now spend more, which allows the economy to grow faster. Our economic system is run on spending, right? The more you spend, the more somebody else makes. If I take $100, I spend it at a restaurant. This restaurant now has $100 that they can use to pay their employees, to invest into growth, to open up a new restaurant, to pay a new chef, to create a new product. So the more I spend, the more money this company has, the more money they have to grow. If I suddenly stopped spending, if the entire country suddenly stopped spending, we saw that happen in 2020 with the pandemic. We've seen it happen in 2008 when people run out of money. People do stop spending. We see it happen all the time. Anytime you see a financial crash, a recession, or a worry about a crash, people get financially smart and they stop spending. What happens? The economy slows down. But then what always happens, every time we've seen this happen in history, is things start getting better and people go back to their old spending habits. In 2020, we saw the biggest credit card pay down in the history of American history. In 2021, we saw the biggest credit card debt increase in the history of time. So, we've seen it happen. If everybody became financially educated, you would see a slowdown in the economy in the short term. But let's assume that now we stuck with that. People stayed financially educated. So now people were able to build their spending. People were able to build their savings. They were able to build some investments. Now what? Now people would be investing their money into more productive assets, into investing their money. Maybe people would invest into new business ideas. People would invest into new factories, into new manufacturing plants. So people would be investing into productive assets. And in the short term, you would see a slowdown because you wouldn't have as many people buying. But if people have now savings, they'd be able to eventually start to buy again. And that would cause a sustainable growth in the economy. And that would cause less booms and busts that we see in our economic system, because now people are not so reliant on paycheck to paycheck spending and living. When the 2020 pandemic happened, this is a prime example. The economy shut down. Less than 2 weeks later, we're in a crisis because a massive chunk of our country doesn't have money to eat. Businesses have no money to continue functioning. Businesses had less than 14 days worth of cash in their bank accounts. Very few businesses had more than 30 days worth of cash to run in their bank accounts. Everybody, from people to massive corporations, were reliant on their next paycheck in order to eat, in order to pay their bills, and in order to survive. And as soon as we saw a slowdown, the whole thing imploded. Now we were quote unquote saved because the Federal Reserve Bank opened up the money printer and they started flooding the economy with free money, right? They started passing out unemployment checks, stimulus checks, bailouts. Just money that started pouring into the economy, which is fine right now because, hey, we're on top of the world financially. We are the world's superpower. We have the world's reserve currency. But it's a concern because we are so reliant on the next check that if anything slows down, who gets screwed over? Well, it's anybody who doesn't have money. And this is where you have to start taking care of yourself. Because what happens if the Fed doesn't save you next time? What happens if the government doesn't save you next time? You need to protect yourself. Because if, let's assume they keep printing and we print a little bit too much, now we're in financial trouble. Because even if they tried to save you, they wouldn't be able to, which is why you need to be smarter with your money. You have to take care of yourself. We live in a dependent system. We assume that, hey, this person will always look out for my best interest. The government is always looking out for my best interest, so I don't got to do anything. The government will take care of me with my Social Security. The government will take care of me because they will always make sure that I'm okay. Hey, if that's what you want to believe, God bless you. But you do not want to rely on somebody else.
People
take
shouldn't
care of
rely
yourself.
on the government.
No.
At least not financially. Is that what you're
Never.
saying?
You always want to take care of yourself. The government's job is to take care of its society. Fine. That's fine. But I don't want to rely on them. I don't want to rely on anybody else, just like I don't want to rely on my parents to take care of me. I want to rely on myself. I want to make sure that I take care of my family. I want to make sure that I can take care of my future kids. I don't got any kids right now, but if I have kids, I want to make sure that I can take care of them. I want to make sure that I can take care of my community. That is my duty. My duty is to make sure that I'm okay. Hey, if the government wants to take care of my city, great. But I'm going to make sure that I'm okay first. And we have to become a little bit more self-reliant on ourselves instead of just keep wanting more from other people, from our government, from our corporations. Yeah, that's okay. We need a better society, but you have to be willing to take care of yourself, and you have to have that sort of financial education to take care of yourself too.
What do you think about the other countries that do give more, at least financially, to their people? They seem to be doing just fine.
Okay, there's a couple things that we can talk about regarding that. If you want to take care of your people, that's fine. There's nothing wrong with that. But there is a way financially to do it. Because look, at the end of the day, money is supposed to be a store of value. And if a country is printing money to take care of its people, well, what is going to happen to that store of value? It's going to get diluted the more and more you print. It sounds great to give free everything. I mean, why do we need to pay taxes if the government can just print the money? I mean, let's just keep going with that, right? If they want to take care of everything, why do I need to pay money to go and buy a home? Why do I need to pay money to go and buy a car? Why do I need to pay money for anything if the government can just take care of it? They can just keep printing that money.
Well, why do you?
Because that's not how our system works. I got to pay for things, right?
Why not?
I got to pay for things. What are you talking about?
Why can't the government just pay for everything? It doesn't, you say inflation, things dilute, the value of our dollars dilute. It doesn't matter if they just keep giving me money, right?
We're going to jump back into the video in just a second. But before we do, I want to talk to you about our Market Insiders program, because if you're interested in investing your money in the stock market and the real estate market, our Market Insiders program can really help you with that. Market Insiders is not a class. It is a weekly group coaching session. Every week, you're going to get access to a live class where you'll learn something about how to invest your money in the stock market and the real estate market. And because these classes are live, you will be able to apply what you learned to the real world. So for example, let's assume that this week's coaching session is on the topic of how to read a cash flow statement. That means for the first half of the class, you might go over what is a cash flow statement, how to find a cash flow statement, what it means, and how to understand it. And for the second half of class, if Amazon released their earnings statement this week, you might actually go over Amazon's cash flow statement. That way you can apply what you learned, since all of these coaching sessions are live. The real estate coaching sessions work the exact same way. You're going to go over a lesson like how to understand the cash flows of a property or how to find an undervalued property, and then you're going to apply what you learned to today's market. As soon as you enroll in Market Insiders, not only are you going to get access to our stock market and our real estate coaching sessions, but you're also going to get access to our stock market beginners class for free that will walk you through everything you need to know to get started investing your money in the stock market. And you're also going to get access to all the previous coaching recordings, that way you can go back and learn more, and you're going to get access to our private community of serious investors. This is our exclusive Discord community that's made just for Market Insiders, and you can go into this community, network with other investors, and you can ask your questions. When I was working to create Market Insiders, there were two things that were very important to me. First, the coaches, because I wanted to make sure that the teachers were real investors, and second, the pricing, because I wanted to make sure that it was very affordable. First, talking about the teachers, all of our coaches have been vetted. These are not some random gurus that we found. These are real investors, people who have been investing their money for years, people who've gotten great returns, and people who have the money behind them. We're talking about hundreds of thousands, if not millions of dollars invested themselves. So these are real investors who are doing what they teach. And on the price side, it was very important to me that Market Insiders was an affordable program. I didn't want to create a program that would cost you $1,000 or $900 to get started with Market Insiders. I mean, it costs less than the price of dinner for two if you want to get started with Market Insiders. And you don't even got to take my word for it, because I know there's a lot of crappy products on the internet. You can try out Market Insiders for free. We have a free 10-day trial where you can go through the entire Market Insiders program, and then you can decide if it's right for you or not. During this free trial, you're going to get access access to everything. You're going to get access to our group coaching sessions. You're going to get access to our free stock market class. You're going to get access to our previous recordings. And you're going to get access to our private community of investors. This way, you can try it out and then decide if it's worth the money or not. If you start Market Insiders, you try it, and then you realize that you hate it, well, then you can cancel your membership during your free trial and it won't even cost you a penny. But if you start Market Insiders, you try it, and then you love it, well, then you can decide if it's worth it or not for you. This way, you literally have nothing to lose. So if you want to learn more and get started with your free 10-day trial to Market Insiders, I'll put the link to where you can get started and join with the free trial in the description below. Venezuela was one of the most prosperous countries in South America. They were flourishing, and people would report about how Venezuela is doing a great job of taking care of its citizens. People should learn from Venezuela. They should be inspired by how they're taking care of their people. Well, ultimately, they printed too much money because they were spending way more money than they were bringing in, which ultimately caused the country to collapse because their currency became worthless. Everything has to be collateralized by an asset. The United States government's spending, our national debt, is collateralized by our GDP, our economy. When you go on, you get a mortgage, it's collateralized by your house. If you take on too much debt on your home prices go down. Well, this is what causes a housing market crisis, because now you're going to be forced to sell your property at a loss, or the bank is going to come and foreclose on you because you have to default. Our spending has to be in line with our economy. Mm-hmm. If the government wants to give free everything, sure, we can do that based with money. Either they're going to have to raise their taxes or pay for it through inflation. Inflation is a hidden tax paid for by the average person. So let's just go with that. The government wants to give away free everything. Okay, well, they're not going to be able to tax enough to make that happen, but they can print it. It's a way for them to kind of bypass the tax system to give away more free stuff. So now the government goes to the Federal Reserve Bank, says, hey, give us $20 trillion. Why not? We want to give people a whole bunch of free stuff. We want to give people free headphones. We want to give people free iPhones. We want to give people a whole bunch of free stuff. Let's give every American a free BMW, right? So now they print that money. They print $20 trillion, and they go out and they buy these BMWs for every single person. Well, they couldn't approve it through taxes, so they have to pay for it somehow. These dollars had to come out of thin air, which dilutes the value of each dollar, which means that now the person who's paying the price is the average person, the average American. Because now when you go and buy groceries, they're going to cost you 4 times more than before, because now you're paying for your free BMW that the government gave you through inflation. And the person who pays now is not the rich and the wealthy, it's the average person, because the rich and the wealthy are the asset owners. Hey, they bought everybody a free BMW. Guess who benefited? BMW and the investors in BMW. Who is that? The wealthy people. So anytime the government spends more money than they have, anytime they spend more money than they earn in order to fund some sort of system, in the short term, it can provide benefit because you get something for free. But in the long term, somebody has to bear the burden of that cost. And more times than not, the person who bears the burden of that cost is the average person who thought that they were getting something for free. And on top of that, the government is a very inefficient system. Companies have to run on profit. Their goal is to make bigger profits. And so if I want to grow, I need to be more profitable. So it is in my best interest to make sure that we are efficient, that we're not just wasting money, that we're not just throwing money away into things that aren't producing any real value, right? Mm-hmm. Because I want to grow as a company. The government works a little bit differently. The government doesn't have to be efficient because they know that they're going to continue to generate tax dollars, right? They're not a for-profit entity. And second, the government actually benefits through inefficiencies because that allows them to create jobs. Because if they can pay for somebody to sit here and move this cup from here to here, what am I doing for the economic workplace? What am I doing for society? I'm producing no value. But hey, if the government can pay me to do that, they have just created a job. Mm-hmm. They have created a new income source for somebody, and they doesn't have to produce any real value. Versus a private corporation can't do that. If I paid somebody to sit here and go like this, guess what? We're going to lose money very fast. And if I keep doing that, guess what? We're going to eventually go bankrupt because we're wasting money. The government can hire people to do that because they're not a for-profit entity. And they, if their goal is just to create jobs, can hire people to do that because their goal is to create jobs. If their goal is to create jobs, which is what a lot of times the goal is, then it doesn't have to be efficient. It doesn't have to be productive. It just has to pay somebody to do something. And so, it goes back to the question of, okay, so why don't they just give free everything? Somebody has to pay for it. And it sounds good in the short term, which is why everybody wants that. But if you start to dive into the finances, it ends up hurting the person it was intended to benefit. And that's what's sad is, the people who end up getting hurt the most are the people who was intended to benefit. We can just go look at colleges, college education. Man, it's so, no, I mean, this is serious. I mean, it's so sad because, I get heated about this. You have so many people, young people, that are signing away their financial lives. They're signing a financial death sentence at the age of 17 and 18 to go to college. Why is college so expensive? Well, the government came out and they promised that they would guarantee student loans for anybody who wanted to go to college. Sounds good, right? Hey, college is expensive and, maybe you can't go to college right now, but hey, we'll guarantee you student loans. We'll guarantee that we will fund your student loans. Colleges heard that, and as soon as they heard that, they started jacking up the tuition prices. They started raising the price of the textbooks. They started jacking up the price of everything because they knew the colleges were going to get paid. They knew the government was going to pay them. They had no reason to keep the prices low because the government guarantees it. So now where does that bring us to right now? It brings us to a whole generation that's screwed over by college because they feel like they need to go and they rack up all these student loans. And now they're saying, hey, government, fix it. Pay off my student loans. And man, it's such a crappy situation because now let's say we do pay off their student loans. What happens? Well, now you're going to have a group of people that are very angry because they're going to say, what the heck? I busted my butt to work through college, to get scholarships, to pay off my student loans when I could have been dumb with my money and get it paid off for free by the government. And then you have the people that get it paid off where unless we can find a way, let's assume you tax the 0.1% and that tax pays off the student loans, how else are they going to fund it? Well, they're going to have to print the money. Well, if we know that the government taxed the 0.1% and they create this tax and this tax then uses to pay off the student loans, we know who paid off the student loans. But if they don't do that, because that's not what's going to happen, what are they going to do? They're going to print that money. And when they print that money, what happens? Well, now you who got your student loan paid off is going to pay it back plus more with inflation because now the price of everything else has gone up. And so, a lot of people assume that, hey, the solution is we need more government. We need to have more government programs, give more free things to everybody. But there is an extra cost that you have to pay for that because now not only are you paying for it through inflation, but the government is not going to do it very efficiently. I mean, as unfortunate as it is, they do not have the incentive to be as efficient with their money as somebody who has a for-profit company, because a for-profit company is going to, if I get $1,000, I'm going to want to make the best use of that $1,000 because I want to grow it as fast as possible versus what is the goal? I mean, if the goal is just to create jobs, then hey, pay somebody to move your cup back and forth because you accomplished your goal. But if my goal is to build more profit, then I need to do something valuable with that money. And, I've seen the problems and horrors that come out of when you just completely rely on the government. My family's from a state in India called Punjab. Our state was bombed by the government because they didn't like that we were asking for equal rights. So in the 80s, our state was bombed. Why? The government had a lot of power. They could do that. They bombed their own people. In 1947, our state was severed by the government. They promised us, oh, don't worry, you're going to have this much land, you're going to have this area. No, they lied to you. They screwed you. And they said one thing, they did something else. When the government has too much power, when they can dictate how you live your life, when they dictate how you're going to be able to live your life financially free, you are reliant on somebody else. And if that's how you want to live, fine, it's a free country. You can choose how you want to live. But if you would rather have the individual freedom where now you can choose how you live, great. But if you want to be able to do that successfully in our society the way it is now, you have to understand the system. That way you can win in our financial system. You have to understand how the financial system works. That way you can win in it. The reason why people hate it is because they don't understand it. I used to do the same thing. I didn't understand how our financial system worked. Nobody taught me this financial education stuff. I was going through school to become a doctor because I thought that's how you become rich. I was doing it for all the wrong reasons. You have to understand our financial system. That way you can win in this system. And the majority of people will never learn that. And that's why people just keep complaining because they don't understand how it works. Anybody can win if you understand how it works. Then you have the right mindset to be willing to put in that work.
And I chuckle about student loans because if I don't, I'll cry. If I don't laugh, I'll cry about it because I know so many millennials that have such high student debt.
Look. You want to talk about student loans? Look at this. It is the number one liability for young people. Student loans are the number one liability for millennials. But you know what? It's also the number one asset for the United States government. The government says they don't want to have the student loan crisis, that is such a bad problem, but at the end of the day, it is funding so much of their operations. And this is where it just blows my mind. Why I cannot trust the government in that sense is because they say one thing but do something completely different.
Right.
They talk about how student loans are a problem. Yet it is their number one asset. And if you don't believe me, go Google it. Go research it because I couldn't believe it myself either. It is their number one asset.
Yeah, I mean, forget a paycheck. A lot of millennials can't even, they're so worn down by their student loans.
And with that, let's transition a little bit to something a little bit happier, to the Guac round, where I answer your personal questions. I am not a financial advisor, and if you want my opinions as a random guy on YouTube, I am going to answer your questions. But again, it's just an opinion. So if you have your own questions that you want me to answer with my opinion, I will put the link to where you can leave me a voicemail in the description below. What I want you to do is, one, tell me who you are, tell me where you're calling from, and then tell me what your question is, and then I will try to answer it on Guac Talk. So let's start with question number 1.
Hi, my name is Regina.
Hi, Regina.
From Los Angeles, California. I'm 67 years old, and I recently inherited approximately $300,000 from my mom.
Okay.
I'm retired already. I have a fixed income of approximately $4,500 a month.
Okay.
What should I do now to grow the money and make sure it lasts me the rest of my life? Thank you so much.
Thank you, Regina. Thank you for calling in. So first thing is, you got this $4,500 of income coming in every single month, which is great. If that income is enough to cover expenses, what I do not want you to do is all of a sudden just boost your lifestyle because you got this brand new set of cash. I don't want you to go out and blow this money because you got this brand new money. So if you want to take this money and you want to use it conservatively, that way you don't have to take on a whole bunch of risk because you're 65 years old, then there's a few different places that you can put some of this money. Take some of that money, put it into ETFs. You don't have to dump all of it in right now. You can dollar cost it into ETFs. That way you get exposure to the general economy. You can take some of that money and use it to invest in real estate. That way you can create a new passive stream of income. You can use it as a down payment on a property. And you could potentially, if you are interested, put a little bit of money into something a little bit more speculative. Have some fun. Maybe cryptocurrency, maybe growth stocks. You can figure out where that is for you. But you want to make sure that you understand, what is it that you need to do with that money? Do you want to increase your cash flow every single month? That way you have more money to spend. Or do you want to just protect the money? Because if you're trying to protect the money, then you got to do something a little bit different. You might want to use some of that to buy something like gold, maybe buy a little bit of cryptocurrency. But again, just don't chase anything because right now prices are very high. So be slow, be cautious, and just make sure that you understand what your goal is. Are you trying to just protect it? Are you trying to create more cash flow? Or do you want to see growth?
Next caller we got here is Lavonda Banks.
Hello.
Hi.
I love your channel, and I appreciate all the content you share.
Thank you.
I just wanted to know, where do you invest in gold and how is it sent to you?
Good question. So if you want to invest in physical gold, there's a couple ways that you can do that. You can go to a gold dealer. They're all over the place. Just Google gold dealers near you. Make sure they're reputable. So, just like how you check with anything else, make sure it's a reputable gold dealer. And when you buy gold, you should be buying them at spot price. So that's kind of one of the ways to know that it's reputable. And so you can go to a gold dealer, or you can use one of the apps online. There are places where you can buy gold passively. And when you buy gold passively, you're buying physical gold, and after you buy a gold bar, then they will mail it out to you. So one of the apps is Vaulted. You can check them out. where now you're going to use an app to buy gold passively. You can buy it every month, or you can buy whatever kind of your cadence is. And anytime you buy a gold bar, you can have it shipped out to you.
Next caller we got here is Maxwell.
Hey, I'm Max. I'm from Wisconsin, here in the great United States.
Hey, Max, how you doing?
I was just looking to see, what are your top, 5 assets for investing?
Sure. So I invest my money in 5 places. I invest in real estate, I invest in stocks, I invest in businesses, I invest in cryptocurrency, and then I invest in commodities like physical gold. I invest in real estate because it provides me with consistent cash flow, and it also comes with its own fair share of tax breaks. I invest in the stock market because I believe in the future of the American economy. I invest in cryptocurrency because it is the people's movement of money, and I also don't trust the Federal Reserve Bank. I invest in businesses because I love investing for innovation. I love working with entrepreneurs. And then I invest in commodities like gold because it is real money. Gold is a store of money. It takes time, effort, and labor to produce an ounce of gold. I don't care about what happens to the price of gold, whether it goes up or down. I look at it like real money. And with that concludes another Guac Talk. Thank you, Nate, for joining me. If you want to see more of Nate, check out his daily videos on the Minority Mindset News channel. He's posting videos every single day on the top finance and business news. This was another episode of Guac Talk. I am Jaspreet Singh, and I'll see you next time. Thank you for watching. If you enjoyed this video, here's a video about investing in cryptocurrency that I think you'll love. And while you're at it, download a free guide on how to start generating passive income. And as always, keep hustling.
So they want you to keep in the system, devalue your savings, devalue your working salaries to try and keep this system alive,